Okay, so first of all, I want to thank everyone for coming. And I would just say that this is a fast-moving topic, and we are going to discuss many things, but I know many of the people who come and are listening know a great deal about this. So I hope you will share your discussion, your thoughts, your links, and other information in the chat, because this is we're all on a learning journey here as the financial system evolves quickly. So let me introduce our team for this evening. So I'm Catherine Austin Fitz. My co-host Tim Cavan is not here tonight. He is taking his son to college, but we look forward to having him back. Susan Lucius, who runs our team Cash, we're hoping will be here. Elizabeth Murphy, who opened us up. Elizabeth leads our state legislative effort and is just a remarkable resource. And I hope you will plug into that resource, get on the mailing list, and just plug into all the wealth of information that Susan makes available. Tobi Maier is a wonderful attorney who we work with in Tennessee, and he has been helping me understand the Genius Act and has just published a great article about the Genius Act at the Solari report, which we will show you later and discuss later in the presentation. And then Ricardo Oskam is helping Elizabeth with the questions and managing the slide deck and has done a wonderful job of making the slides. And Ricardo, thank you for a great job on the slide deck. So for everything we're going to discuss tonight, there's a wealth of information. Next slide at the Solari report. This is just a picture of many of the different wrap-ups we've done. And if you look at some of the analysis that we show tonight, many of these are different pieces that lead up to some of what we have to say. But there's a wealth of information, and some of the members of the Solari team are here tonight, including Carolyn Betts, our general counsel. And if you, as you ask questions in the chat, they will post links to different materials at the Solari report that may be helpful. There are 4 sections to our briefing tonight. The first is just a discussion of what is stablecoins, and then we'll talk about the Treasury bond market and federal budget. There's a lot of background information and context that I think is important to understand stablecoins, and so this is going to go through we've got about 50 charts to go through, so we're going to have an in-depth discussion on what's been going on in the Treasury bond market and how this fits in. Then we'll give an overview of the Genius Act, and I'm going to ask Tobi to say a few words about the programmability of stablecoins under the Genius Act, and then we'll talk about what state officials and legislators can do, what's the action, and Susan is going to, we believe the number one thing you can do is keep the system from going all digital, keep it analog, and protect cash. And so I'm going to ask Susan to say a few words. After each one of these 4 sections, we're going to be taking questions and answers to make sure that you understand the section that we've completed. So I don't want to go to the Treasury market until I'm sure you understand what stablecoins are. I don't want to go to the Genius Act until you've got a good background on the Treasury market, et cetera, et cetera. So with that, let's dive in and start with stablecoins. What is a stablecoin? So a stablecoin was first sort of created because many cryptocurrencies were volatile, and a stablecoin was meant to be a cryptocurrency or a digital asset that could be used on a cryptocurrency track that would be stable in value. So it would make transactions or facilitate transactions more easily. In theory, it's a coin that's tied to another asset or coin. So it could literally be in many different assets. But under the Genius Act, we're talking about stable coins that are tied to the dollar. So that a dollar of stable coin is worth $1. And it's designed to be stable in value. If you look at this chart, there are approximately, as of July 17th, there are approximately 265 billion stablecoins outstanding. And so this chart shows you Bitcoin at that point was at $2.4 trillion, Ethereum at 417 billion. Stablecoins third at 265 billion. So it's a growing part of the market. Take a look at the next slide, Ricardo. Okay, so this is just another way to look at it. So here's Bitcoin at 2.4, Ethereum at 435 billion, and then Tether is the largest stablecoin at 162. So go to the next chart. So here's the market capitalization of the 213 different stablecoins. We're just showing the top ones. Again, on July 17th, with Tether clearly significantly all above the others at about 160 billion. USD coin is the Circle coin at 63 billion, and then down from there. Okay, next slide. And this shows you the growth. Stablecoins were growing steadily when the Silicon Valley Bank went down. There was some concern. One of the stablecoins had a pretty big deposit at Silicon Valley Bank, so there was sort of a period of pause, and then they've been growing ever since, and you can see it here. But and after the inauguration of the Trump administration, which has been very supportive of cryptocurrency, you can see you start to get a rise. And but we would expect that the issuance and the growth of the market after the Genius Act will be significant for a number of reasons, but one of them is it provides a regulatory framework that gives sort of some clear direction to the market. One of the things I've noticed in the last, ever since the inauguration and the stress of the administration on crypto and including stablecoins, is to listen to the media. You would think that this was, a huge part of the market. But I want to stress again how, even though 4 trillion sounds like a large market capitalization, within the scheme of the global financial markets, this is absolutely tiny. So this is a chart. It's a little bit old. It's from 2023 from the London Stock Exchange, showing the size of the capital markets. At that point, the digital assets, including Bitcoin, was 1.8 trillion. So now it's 4 trillion, but you're talking about 1 quadrillion of assets. Equities probably, approaching 200 trillion, the bond market bigger than that, and of course derivatives and the currency markets bigger than that. So in the scheme of the global financial markets, this is still a very, very tiny market. But if you listen to the extent that it's being promoted, it's exceptionally significant. One of the things I should mention, we'll talk more about it when we get to the Genius Act, is stable coins are assumed to be or required to be issued on a distributed ledger. So we're talking about a form of crypto that is on a distributed ledger. And again, most of the assets in the financial markets are not on distributed ledgers, and that's what makes the digital assets very, very unique in the whole scheme of things. Okay, Elizabeth and Ricardo, any questions about stablecoins? What is stablecoins?
No questions yet. Somebody said if stablecoin is supposed to be stable in value, it's not stable if it gains value, let alone loses value.
Correct. Right. And certainly we've seen stablecoins trade way off of their collateralized value for a variety of reasons. If you look at the regulatory structure of the Genius Act, I would expect them to become much more stable in value, certainly the dollar stablecoins. And the Genius Act does require that the existing outstanding stablecoins conform to the Genius Act, including very strict auditing requirements, monthly auditing requirements. Okay, so let's go next to our next section, which is Treasury market.
Catherine,
So
I'm sorry, we did have a question that just came in. Is it true that most stable coins are based on elliptical curve cryptography? I'm not sure if you can speak to that or not.
That's an excellent question, and I don't know the answer. The Genius Act does require the distributed ledger to meet certain standards of cryptography, but what I would do is ask the audience, is there anybody who knows the answer to that question? Good question.
And then Randy asked, does stable coins require a base asset like treasuries? And then Karen has the question of how will this affect the everyday person when we no longer have cash, which is maybe
right. So we're going to get to those. And yes, it does require a base asset, and that's what we're going to get into when we start talking about the Treasury market and the Genius Act. Okay, so let's do some background on the Treasury market. Next slide, Ricardo. Okay. So it's very important to understand the context in which the Genius Act was passed. If you paying a lot of attention to the news, it'll look like the administration and the Fed are not enjoying a close relationship. The reality is, if you read the Genius Act and you look at what's going on, there's been very good coordination, it appears, between the Treasury Department and the Fed on crafting the Genius Act and doing it in a way that it works very successfully with all the different banking regulations. So this clearly indicates very healthy and good coordination. In 2019, the Fed met with the Kansas City Fed holds a meeting in Jackson Hole every year, and all the G7 central bankers come together to talk various issues that they coordinate on. And in 2019, they reviewed a plan from the BlackRock Investment Institute called the Going Direct Reset. And you will read and see a lot of information.
Well, let me move to something which is more about technological change and new kinds of instruments, cryptocurrencies. How do you see the potential for more favorable regulations coming on them, and potential risks from that for the system?
So we went through a wave of failures and fraud and things like that were the headlines for a couple of years. And I think what you see now is, and during that period, by the way, we worked with Congress to try to get a legal framework for stablecoins, which would have been a nice place to start. We were not successful. I think that the climate is changing, and you're moving into sort of more mainstreaming of that whole sector. So Congress is again looking at both the Senate and the House are looking at a legal framework for stablecoins. Depending on what's in it, that's a good idea. We need that. There isn't one now. And stablecoins are a digital product that could actually have fairly wide appeal and should contain consumer protections of the typical sorts and transparency. And that's what the Senate and the House are working on. So that's a positive thing. I also think some of the, we took a pretty conservative, and other bank regulators took an even more conservative perspective on the guidance and rules we imposed on banks. I think there'll be some loosening of that, and I think we'll try to do it in a way that preserves safety and soundness, but that permits and fosters appropriate innovation, but that does so in a way that again doesn't put consumers at risk in ways they don't understand or make banks less safe and sound.
Okay, so that was Chairman Powell of the Federal Reserve immediately before the Genius Act was passed. Okay, next slide, Ricardo. This is it from the Federal Reserve Research Department, St. Louis Fed, called FRED. And what we're looking at is the federal surplus or deficit, starting sort of at the beginning of the 19th century and coming into the current year. And what you see is from about 2000 on, the deficits have been growing bigger and bigger. And obviously during the pandemic, they grew very wide. And what has been happening since is the deficits continue, we bounce back, but they continue to grow. And the current report will show you one report from this year is the deficits are growing, and we are currently in line to have the third largest deficit ever, the largest two being in the pandemic. Next slide. So the Fed is looking at a major deficit. Okay, we have a report in the Going Direct Reset, which, as I said, was the plan that the Fed and the G7 central bankers reviewed at the G7 meeting in Jackson Hole in 2019. If you go back through history, every 100 years or so, 80 to 100 years, the central banks appear to do a reset, and this is the current one. And what we're talking about is a radical change in how the financial system is organized. We've written a lot about it at Solari, starting with a wrap-up called The State of Our Currencies. But we also have a wrap-up by John Titus on the Going Direct Reset. Okay, next slide. So here's a chart that shows the Fed assets coming into the reset. So we show the August 22nd, 2019, when the central bankers approved the going to or discussed the going direct reset in Jackson Hole. And as we know, then the pandemic starts, and we see an unprecedented injection of assets into injection of money into the system by the Fed buying assets, including from non-financial firms. And this is extraordinary. The going direct refers to the Fed injecting money directly into the economy. And we've talked a lot about this at the Solari report. I'm not going to cover all that today. Next slide. But what that meant was that the debt and the Treasury bonds, the federal debt that the Federal Reserve held on its balance sheet, skyrocketed. And as that debt has matured, the Fed has been letting it roll off. And so, as you can see, during the pandemic, the Treasury debt on the Fed's balance sheet skyrocketed, but now it's declining. And it's very interesting if you look at that decline and you project it into the future, it very much looks like the Treasury is hoping that stablecoins will trigger very large purchases of Treasury bonds in approximately the amount that it looks like the Fed is shedding. And so, interestingly enough, what we see is the administration proposing signing an act that will essentially help the Fed get out of the Treasury market. Next slide. So this slide shows the total public debt. For those of you who've been listening to the headlines, we've just passed 37 trillion in Treasury bonds and bills outstanding. That's the public official figure. That's just Treasury bonds and bills. It's not all liabilities of the federal government. And there is increasing concern around the world as to who's going to buy our debt and what the value of the dollar is. If you look at polls around the world, the number one concern in Europe and the United States is inflation. If you look at the injection that the Fed made during the pandemic, that is extraordinarily inflationary. And what we're seeing, among other causes, is prices rising as a result of what that did to the money supply. So right now we have 37 trillion in total federal debt outstanding, Treasury bonds and bills. Next chart. Okay, so this shows the federal debt held by the public, which is approaching 30 trillion. Next slide. And a great deal of that is held by, so we have a past 7 trillion owned by federal agencies and trusts. One of the biggest investors in Treasury bonds and bills is the Social Security Trust Fund, which is essentially invested in all treasuries. Okay, next slide. Foreign and international investors continue to buy treasuries, although there's been a big shift by China out of treasuries, with some of our European allies picking up more, but international investors continue to buy treasuries as well. One of the reasons that the Federal Reserve is holding interest rates high is to try and keep that cohort of purchasers in and buying treasuries. Okay, next slide. Okay. One of the things we've seen that is a defining characteristic of the Treasury market in the last 20 years is starting in fiscal 1998, we've had what we at Solari describe as a financial coup. There's a great deal of information at the Solari report about it, but as of 2017, when Dr. Mark Skidmore and I published his report on what was then $21 trillion of missing, unaccountable, and undocumentable adjustments in the federal books. At the time we published that report in 2017, there was 21 trillion of outstanding Treasury bills and bonds. What happened after that report was there was a lot of tension in Washington over the fact that the U.S. Treasury, because of DOD and HUD, has never yet produced audited financial statements required by law. And the reconciliation of that was something called FASB 56, which is a policy issued during the Trump administration in October 2018 during the Kavanaugh hearings. And it was basically a policy adopted with the approval of the House, the Senate, Republicans, Democrats, and the administration. And essentially what it said is the US government could keep secret books. So the government is in massive violation of its requirements to disclose its finances. And it has now adopted a policy that allows it to keep secret books, and nobody and nothing has changed that. That policy was followed the next year by the going direct reset discussion, and that's when we proceeded with the pandemic. And as many of you know, what I believe is the pandemic was really an economic reset. It had very little to do with health. And so Operation Warp Speed essentially shut down Main Street, injected $5 trillion into Wall Street, and allowed a massive consolidation of market share and assets into centralized hands. Anyway, there's much more about this at Solari. If you go to the next slide, the two pieces I would recommend to anybody who wants to understand the economy. First of all, we have two wrap-ups where in 2018, we rolled up all of our documentation on the 21 trillion missing and put it in two hard copies and shipped it all over the world to make sure it could never get censored. And then next slide, we have two summary pieces, one called Caveat Emptor that Carolyn Betts helped me write, why investors need to do due diligence on U.S. Treasury and related securities. And then the other is detailed look by two attorneys we work with on FASB Statement 56 about keeping secret books. Now, why is this important? What this means is there is no financial disclosure, not just of the Treasury market. So you don't have any of the disclosure required by law, and the books now are secret. FASB 56 applies not just to the U.S. government, but to 150, so it's the 24 covered agencies, 150 plus governmental entities, and with the national security and classification laws, it extends to the big banks and contractors who do business with the government. And what that means is there is a significant part of the US securities market where essentially the financial disclosure, in my opinion, is meaningless. Anyway, you can read these two pieces to learn more about it, but it's not surprising that we should find ourselves in a situation where it's getting more and more difficult to finance the federal government, not just because spending is rising and deficits are rising dramatically, but secrecy is rising dramatically, and that has an impact on investors' willingness to invest. Okay, next slide. So let's say you're the incoming administration and you're the new Secretary of the Treasury. What are the challenges before you? One of the challenges is how are you going to generate revenues? If you look at what's happening with tariffs, tariffs is one way you can quickly generate revenues. But another challenge you have is as interest rates have been coming down, several different, over the last 12 years, the Secretary of the Treasuries have been bringing in the maturities of Treasury bills shorter and shorter because they pay lower interest rates on short-term debt instead of long-term debt in an upward sloping yield curve. As a result, we have more and more treasuries that are maturing sooner. And with interest rates now much higher, it's the last time in the world that a Treasury Secretary wants to, go out and finance long because they're trying to bring the interest rate prices down as much as possible. So if you look at this chart, what you'll see is a maturity profile of our outstanding federal debt. And what it shows you is we have very significant maturities this year and next. So if you're the Secretary of the Treasury, what you're thinking is, how am I going to sell literally trillions and trillions of dollars of Treasury debt? The latest press release from the Treasury in the next quarter, they have to sell, I think, 1.5 trillion of Treasuries. And of course, if the Fed is lowering the position, they're not necessarily there to buy. So what are you going to do? Okay, next slide. So this is from a company called Geiger Capital, and it shows you our surplus and deficit for the year so far in 2025. What the administration's been able to do is bring in a fair amount of new revenues by tariffs. But in fact, if you look at the size of the deficit is rising. It's not anywhere near enough to fill the gap. This is a picture of the outlays and the revenues that include Social Security, which is a trust fund in one sense, shouldn't be integrated in the budget. But if you look at Social Security, right now we're basically bringing in what we're spending. But the reality is the individual income taxes is nowhere near enough to pay for an exploding amount of interest. You can see the interest so far this year is more than the national defense. So interest has surpassed national defense. One of the things that we continue to remind you and constantly bring up is how extraordinary and explosive the healthcare expenses are. And you see that here, not just in health and Medicare, but in fact, there's a portion of Social Security, which is Social Security disability. And go to the next slide. So one of the things, we just had a great interview on the Solari report with Dr. Mark Skidmore, and one of the things he pointed out is if we could return to 2010 levels of disability, we could lower healthcare expenses in the federal budget $500 billion a year. So last year, the total healthcare expenses on the federal budget was 1.8 trillion, and he's saying you could lower that by $500 billion if you just radically reduce disability. So if you look at deficit drivers, what are they? One is inflation, one is the great poisoning, one is interest expense, and one, of course, is the military. We continue to try and operate a massive global military operation, which is part of what has maintained the dollar as a reserve currency. And of course, the challenge in a central banking warfare model is how can you make sure that your military, the money you make off of running the reserve currency is sufficient to fund your military and your expenses of maintaining that reserve currency. And part of what you see the current administration doing is struggling with trying to come up or evolve that model because their interest expense is exploding. And of course, the great poisoning is really rocking their expenses. Okay, next slide. Now, one of the things that has happened slowly and steadily over the last 20 to 30 years is more and more of the US economy is running through the federal budget. So what you're seeing, you come into any county, there are 3,100 counties in America, and more of the revenues and income in a county, directly or indirectly, come from checks from the federal government, whether it's a corporate contractor who's working for the government, or it's an employee who's working for a defense contractor, or it's a federal employee or somebody at state and local government who's working, but the money's being funded by the federal government. And what's interesting, when I first got to the Department of Housing and Urban Development in 1989, I did an analysis of our budget, and I discovered, when we had started some of the Section 8 programs, of a dollar we spent, 70% or more went to the recipient or into the local economy. By the time, I had arrived in 89, about 29 cents was going into the recipient of the local economy. And what you had was an extraordinarily rich world of intermediaries, whether they were contractors or not for profits or state or local government. But you had an enormous intermediary infrastructure that was really more about control as opposed to the economy. And so we're seeing more and more of what I would call a Soviet kind of economy that really increased a lot during the pandemic. If you look at this chart, I would say they're saying it got as high as 30% in 2020. In my experience, if you look at really all the indirect money coming through, especially the corporate contracts, in many counties, it's 40 to 50%. It's much, much higher. And of course, the more you see that dynamic, the less productive the economy becomes, the more centrally controlled it becomes. It's a way of buying political favor. And many of the fights in politics in America are a fight to control that credit and appropriation flow. And one of the things we've long hoped for is much more decentralization. But in fact, it's going the other way. Now, one of the things that's very interesting over the last 10 or 20 years that is very important when you look at stablecoins is we've seen tremendous pressure on the banks since 2000 to, instead of making loans on Main Street, to put their money into the investment portfolio and buy treasuries. So there's been tremendous pressure quietly within the banking system to stop feeding and supporting small business and small farm and instead cycle the money to the government. The government borrows money through the Treasury market, and then it hands out money at grants, and you get central control of the economy. And this is a very important dynamic historically that could increase radically with stablecoins. Okay, next slide. Okay, so that's the background. The background on stablecoins is there is hope through the Genius Act that stablecoins can explode the demand for treasuries, and we'll talk about that in the next presentation. But the background with the Fed sort of reducing their treasury holdings, with foreigners becoming much more careful about what they're buying, the question is who's going to keep treasuries going as the deficit continues to rise. And that is the backdrop, and it's very important to understand that backdrop when you look at stablecoins. So before we go on, any questions about the Treasury market or federal finances?
Someone asked Catherine, and I think you kind of covered this. Will you cover the aspect of the Genius Act that allows, I think Tobi will cover this in his section, covering, yes, blocking or freezing.
Programmability.
Yeah.
Programmability.
Tobi will go over that one.
Yeah. So one of the things, and I'm laughing because Tobi's heard me say this many times, one of the things I always say about stablecoins vis-a-vis CBDC is meet the new boss, same as the old boss. Okay, so let's go on to the Genius Act.
Catherine, there's just a question that just came in from Susan Lucius, which I think is worthy of mentioning. So I'm going to go back up to the.
So unmute Susan.
Here we go. So this is from the Financing the Dollar Hegemony.
Uh-huh.
Susan, do you want to ask your question yourself? Go ahead, please.
Sure, I'll ask my question. So in 1994, it says the Fed buys BIS shares in this slide. And I'm wondering, what is the significance of this? Does this mean the Fed is controlled by the BIS? And why is this an important event that you would put on this slide?
So the Fed has always been active in the BIS, but it had never been a shareholder because it had, it had said the reason it hadn't become a shareholder was it considered it a conflict of interest. And the Bank of International Settlement, so in October 1994, both the New York Fed and the Fed bought shares and became shareholders in the Bank of International Settlements. And I've always believed that was a very important moment. And one of the reasons I believed it was a very important moment is the Bank of International Settlements has sovereign immunity, and it has the ability to move money anywhere in the world and hold it on its balance sheet secretly. So in theory, you could literally, now, the New York Fed is the depository for the US government, and the New York Fed oversees the primary dealer network. So the New York Fed is basically overseeing the process by which our treasury or the government treasury bills and bonds get sold to our pension fund. The money gets deposited at the Fed, and then the money disappears. That's what the undocumentable adjustments are. And how much money is really missing, more than 21 trillion or less? To know that, you'd have to get the bank statements, okay? which we don't have access to, but the New York Fed would control. Now, if the New York Fed has a shareholder relationship with the BIS, I believe that they can literally ship money anywhere in the world through the BIS or park it on the BIS balance sheet, or through the BIS park it in the offshore havens during the period that the money left, it ballooned. And there was an effort in 1995 to get the U.S. government on a financially sustainable basis. And when that budget deal blew up and failed, I was told by the head of CalPERS, the largest pension fund in the country, whoever they is, have given up on the country. They're moving all the money out starting in the fall. And he said that to me in the spring of 1997, and the money started to move at the beginning of fiscal 1998, which was October 1997. So I've always believed that the Fed changing its policy and saying it's no longer a conflict of interest and we're buying shares in the BIS signaled a much tighter integration and relationship between the New York Fed and the Fed, because it's not just the Board of Governors. The important institution here is the New York Fed and the BIS. And what's interesting is it was right at that moment that Bob Rubin, this is coincidence of all times, introduced Epstein to the Clinton White House. And from that time in 1994 to the time the Clintons left, Epstein, I think, was at the White House, I don't know, 14, 15 times, according to Whitney Webb. And my belief is that Epstein was part of the money laundering operation. And, all this money flying back in, being donated from countries around the world to both the Clinton and the Gates Foundation. One of my questions is, was that money just coming out of DOD and HUD?
Awesome. Thank you, Catherine. That answered that. Can I ask a sort of follow-on question, if you don't mind?
Please.
So, FASB 56 in 2018, I asked my U.S. representative about this. He said he has never heard of it before. He did not vote for it, and he has no responsibility for it. So how would you answer to that? I mean, what is sort of the solution to FASB 56?
I would say to him that he is responsible under the Constitution that the federal government obey the disclosure and appropriation laws. And so he can say he's not responsible for FASB 56. He is responsible that the government produce audited financial statements as required by law, including the laws that say they have to have audits, and they refuse to have audits. So think about this. The federal government has refused since the mid-90s, both DOD and HUD, and certainly DOD continuing, has refused to produce audited financial statements as required by law. Now, we are required to give them financial disclosure. We file a 1040 every year because we're required to tell them how our money worked. They're required to tell us how our money worked. And you are not, under the law and under the Constitution, supposed to appropriate any money unless you are not supposed to spend any money unless it is authorized in an appropriation. When I have $21 trillion of undocumentable adjustments, I have massive spending that has not been envisioned in an appropriation. And there is no reason, and he is responsible.
So the solution, if he were to want to do something, which he probably doesn't, but if he were to want to do something, the thing to do would be to no longer appropriate any money to DOD or HUD until they produce these audited financial statements. Is that correct?
Right. But the other thing I would do, I wouldn't audit the Fed. I would audit the Treasury bank accounts at the Fed during those periods. So the Treasury bank accounts and any related to DOD and HUD. So I would identify where that money went and I would get it back. And now I met at a town hall meeting in the early 2000s with a Tennessee congressman who was on both the Budget Committee and the Defense Appropriations. And I said to him, we were in the meeting and all my neighbors were there. And I said, there's at that point, it wasn't 21 trillion. I only knew about 3.3 trillion. I said, there's 3.3 trillion missing from DOD. And he said in front of everybody, yes, I know. And I said, what are you doing about it? And he looked at me and he said, nothing. There's nothing I can do. He was voting for the $48 billion increased appropriation after 9/11. So I got together with my Bible class and we wrote a letter to him and his staff saying, here are all the things you can do. And I will find that link and I will make sure it's in the show notes for this thing. And because you can just work off of it in a funny kind of way, not that much has changed. If you look at the fundamental, the laws, we have briefing papers at the Missing Money website that we have 7 briefing papers that we prepared over a 2-year period that summarize all of the federal financial management laws for both fiscal and monetary policy. And it's, if you want to understand the laws of the federal government related to financial management, it's a great series of summaries. But the other thing I'll tell you is the law is very good. But of course, it doesn't mean anything if you don't follow it. And the reality is Congress has refused to follow the financial management laws, for many years, but they completely broke out in 1998 and just said, we're going to completely ignore them. The title of the item, and you can find it on the website, is called Saving Tennessee. It's got a picture of Elvis on the bus at the top. And in it, there are 3 documents related to questions for the congressman. And if you could put those in the chat, if you can find them. If not, I'll find them and get them in the show notes. Sorry, Elizabeth.
I'm
Next
on it.
question. Okay.
Okay, so this is from Scott. He says, do you believe stablecoins were a long developed plan or a recent one to segue U.S. Treasury debt from constraining institutional international markets to retail markets?
So I think crypto is a long-standing plan. It was started to try and evolve towards programmable money. But I also think you're watching a group of people who are kind of making it up as they go. And as stable coins got tested and tried, they realized, wow, this is a great way. First of all, instead of doing a national CBDC and letting countries around the world do national CDs, all reporting up to the BIS, this is a way to do a US CBDC that you can market to everybody on the planet. So instead of just Americans being on the American CBDC, we can get 8 billion people around the globe on an American CBDC. And not only that, we'll be free of Congress or relatively free of Congress because instead of issuing it through the New York Fed, we'll just issue it from a variety of issuers, the lead ones being the owners of the New York Fed. So as I said, meet the new boss, same as the old boss. So I think there's a certain amount of I think from the beginning, crypto was being prototyped. And I think some of the plan for stablecoin has been developed in response to the prototyping and what they discovered as they went along. So it's a combination.
Catherine, before we move on, there have been several questions on the financing the dollar hegemony. So this chart that we're displaying, and in 1995, the great poisoning begins, it says. And there have been several questions for people who are new to this concept, what that means, what it entails, and why it started in 1995. When then, in particular?
Okay, so if you look at what happened in 1995, there was an effort by the people who run the financial system to get the financial system on a sustainable basis, the federal budget. And it didn't work, it failed. And part of the tension was the fact that you have baby boomers like a pig through the snake moving through the system with many promises in both the private, state and local, and federal pension funds. Now, what you've been doing is you've been trying to get them on a financially responsible basis. You can't get them on a financially responsible basis. And when the budget deal busted, they threw up their hands and gave up. If you've ever seen my red button story, you'll see a little bit about what that's all about. And so I think a decision was made. We can't function within this governmental structure any longer. And so what we're going to do is we're going to start a new structure, and we're going to steadily move the assets out of the old structure into the new structure. Well, what does that mean? Essentially, you're going to empty out the pension fund of their assets and stuff them full of things like treasury bonds, where I, as a pension fund beneficiary, have traded actual money I put in my pension fund for an IOU for myself as a taxpayer. So it's a way of forcing financial responsibility on the citizens through the pension funds. It's sort of a very ugly picture. Now, when it started, I became extremely concerned. And so starting in 1999, I've been writing and publishing about this because my concern was when the baby boomers got to retirement age, there would not be enough money. If you steal the money out of the storehouse that they're planning on retiring with, whether it's because you're filling Social Security up with low interest paying treasuries and financing the government at their expense, or you're filling the pension funds up with treasuries, when that money, that asset isn't staying in the government, it's disappearing. What you're doing is you are slowly draining value and purchasing power out of the retirement system, whether it's Social Security, state and local pension funds, or the private pension funds. And so what I kept saying to everyone is, because they would say, this topic is very boring, we're not interested, why do you keep bringing this up? And I said, because if you don't fund the pension fund system properly, there's only one way you can balance the books, and that's by lowering life expectancy. And in fact, as soon as that budget deal busted, we started to see policies adopted within Washington that started to slowly and steadily lower life expectancy. It started with the lower income neighborhoods. So literally the month after the budget deal busted, OxyContin was approved by the FDA. The predatory lending was radically increased by HUD. And you saw between the pill mills and mortgage fraud, those neighborhoods, many, many lower income neighborhoods decimated. And I'll never forget, after Dr. Skidmore came in and did the report in 2017, we tried and tried to get a lot of attention paid to the missing money, and DOD was scrambling because it couldn't produce an audit, and it had promised to produce an audit many other times. And so finally, when FASB 56 was adopted, he said to me, how come you keep bringing this up? Why don't you just give up? And I remember, and it's a very famous moment for me. I'll never forget it. I'm sitting in a parking lot in Bolivar, Tennessee, running errands. And I said, Mark, don't you understand? If we don't deal with this financially, they are going to have to accelerate the lowering of life expectancy. And so when the pandemic started, everybody at Solari said to me, or in our network said, how come you knew right away? And I said, because this is how they're going to lower life expectancy. This is the injections are going to lower life expectancy, which is exactly what happens. And if you look at life expectancy charts of the United States versus the top 19 other industrial nations, what you'll see is they're all going up together. And then in 1995-96, as the financial coup is about to begin and the deal busts, it starts to slowly separate. The U.S. slowly starts to diverge from the other 19. And then, of course, it keeps diverging, slowly diverging, and then it hits the pandemic and falls off. And so the divergence in life expectancy between the United States and the rest of the world, in my opinion, reflects, policies that basically say the way you balance this budget and the way you deal with the missing money is you simply lower life expectancy. Now, I say that, and it helps with all sorts of metrics on the pension system. If you look at what it's doing to the federal budget, it's exploding the budget. And the healthcare costs of the great poisoning are exploding the budget. So it's like the Pillsbury Doughboy. You can squeeze down and help the retirement systems, but now you're getting an explosion on the budget. I work with one financial planner who's been tracking Social Security, and it looks to me like the great poisoning has significantly improved the actuarial health of the Social Security system, but it's still early, so we'll see. Any more questions, Ricardo and Elizabeth?
Yeah, we had a few come in. I'm going to combine these two into one. Someone asked, stablecoin is stablecoin being backed by a debt vehicle rather than an asset vehicle? And someone else asked, if the stablecoins are backed by federal treasuries and stablecoin companies begin buying more, treasury demand will increase, Fed rates will increase, Fed debt will then decrease, and will the interest expense on the debt be reduced? Is there some benefit to this?
So that's I'm going to put aside, is there some benefit to this? If you want more of the economy running through federal control, then you think there's a benefit. So let's get into the Genius Act, because what stablecoins is expected to do is, think of a stablecoin as essentially a tiny bit of Treasury bill. The stablecoin is going to be collateralized by Treasury bills or high quality bank deposits. And what is hoped by the Treasury is this is going to explode the market for short-term Treasury bills. Under the Genius Act, you can only collateralize a stablecoin with a Treasury bill, a bond, or a note that is 93 days or less in maturity. So one of the things we've seen from the chart that I showed, that the maturity profile of the U.S. government is coming in shorter and shorter and shorter. This is potentially going to shorten it more. Anyway, so let's go to the next section. And okay, here's a picture of the Genius Act. This just passed and was signed by the president. There were 3 bills related to crypto coming through at the same time. One is the Clarity Act, which is supposedly a regular framework for all crypto other than stablecoins. The Genius Act was stablecoins, and there was also an anti-CBDC bill. And before the recess, the Genius Act finally got through and was signed by the president. The other 2 are pending. Okay, so let's go to the next, I think it's a video. Okay, so this is the Secretary of the Treasury talking about stablecoins.
If really we went big into stablecoin in this country, what effect could that have on the strength of the dollar? Because people might have to hold dollars in order to match against it, or even for treasuries.
Well, we are going big on digital assets. So Trump administration has made digital assets a priority. Past administration starved and almost made extinct a lot of these companies and pushed it offshore. So what we want to do is apply the highest U.S. regulatory and AML standards to digital assets, especially stablecoins. And I've seen estimates that just over the short term, stablecoins could create $2 trillion of demand for U.S. treasuries and treasury bills. To put that in context, the number is probably about $300 billion right now.
Okay, so let's look at the next slide, which is a tweet from the Secretary. Recent reporting projects that stablecoins could grow into a 3.7 trillion market by the end of the decade. Now, here's what's very interesting about this number. If you look at the treasuries that the Fed is shedding, or the drop in their treasury position, and then if you look at the projections of how much the big beautiful bill, which recently passed, adds to the deficit, this sounds like a big number, but it doesn't even plug the hole that's been created by the big beautiful bill. And it certainly doesn't plug the hole created by a combination of the Fed shedding and the big beautiful bill adding to the deficit. So, question mark, how is this going to work, and can they take that number much higher? So hold on to that thought as we look at the next pieces. Okay, next slide. Okay, so this is a tangent from stablecoins. This relates to some of the negotiations going on the tariffs, but I think it's very important to understand the Treasury's approach to other countries around the world. So go ahead and play that if you can, Justin.
We have these agreements in place where the Japanese, the Koreans, and to some extent the Europeans will invest in companies and industries that we direct them largely at the president's discretion.
And how does that work? I mean, it's almost like an offshore appropriation. I'm not sure we've ever had anything like that in the States before. Have you consulted with the, I don't know, the Senate Finance Committee or the House Ways and Means Committee, or what?
Well, Larry, I think a good framing of that is other countries, in essence, are providing us with a sovereign wealth fund. So
they're going to buy our goods. That's essentially what's going on.
Well,
or wait, let me step back. They're going to build our factories. They're going to help us to build new factories, which Mr. Trump loves.
Exactly. So the way to think about it is these huge surpluses accumulated offshore. Let's take Japan. We're going to have 550 billion, and they will be reinvesting that back into the U.S. economy, and we will be able to direct them as we reshore these critical industries. We are trying to de-risk the U.S. economy from what we saw during COVID.
President loves new factories. He'll take rehabbed old factories, but he loves new factories. And
So this is extraordinary. What we're saying is we're going to dictate to other countries that they pay, we're doing the tariff negotiations, but that a portion of the money, we will dictate that the money will not come into the U.S. Treasury, but it will be invested in corporations that the U.S. government and the president steer the money to. I mean, it's one of the most planned economies you'd ever want to imagine, but I think that's the backdrop for the approach we're seeing, and it's going to dovetail with stablecoin. Okay, so next slide. Okay, so I'm going to go through this very quickly, and if you're interested, I would encourage that you read the Genius Act. But I want to very quickly describe what they've done. They've created a framework that makes stablecoins much more predictable, much more understandable, and much more centrally regulated and controlled. So it's going to bring lots of standards and oversight to the market, but it's also going to make stablecoins very, very compatible with central programming, and we'll discuss that when we get to the end. The regulators of stablecoins will be the banking, essentially the banking regulators. You have a combination of the Office of Comptroller of the Currency at Treasury, plus the Federal Reserve, plus the FDIC. The Federal Reserve and the FDIC come in for state issuers. You also have the possibility of state regulators for issuers of $10 billion or less, so smaller issuers. And if you look at how the Genius Act is written, they clearly believe that many of the issuers will be subsidiaries of existing banks. So you would expect the depository institutions to create subsidiaries that issue stablecoins. And the beauty of stablecoins from the banking system's point of view is they're not FDIC insured, so you can avoid FDIC insurance. And they are not essentially on the balance sheet of in the first round, they are not on the balance sheet. Question is, can they be moved on the second round? Now, foreign companies can issue, or foreign banks can issue stablecoins, but they have to be subject to a similar regulatory regime, and they have to be approved by OCC. So you can assume any foreign issuer is going to be essentially controlled by the federal regulators. Stablecoins need to be on a distributed ledger with a certain standard of cryptography. There are very strong collateral and audit requirements. Essentially, if you look at the collateral fraud that has existed in and around the U.S. financial system, it's extraordinary. So you can see why, if this is going to go from a marketing standpoint, you would want very strict audit and collateral requirements. And so essentially, you're subject to a 30-day audit audit regime. You know, in many financial entities, you have quarterly or annual. The 30-day is because this is essentially you're trying to operate in the currency market, so you need a shorter period. The collateral is supposed to be as risk-free as Treasury securities can be. So you have to be in Treasury bills or bonds and notes that have a maturity of 93 days or less. And that's supposedly to protect the stable value. So if the Secretary of Treasury says we think that's going to create $3.7 trillion of demand, remember, those are for Treasury bills that have to keep rolling, rolling, rolling. And if you think the federal government is in a debt trap now, it's just going to make its maturity shorter and shorter and much more dependent on the central machinery. But there are very tight collateral and audit requirements. And if you combine that with how the regulators are set up, I assure you, you are going to see very tight central control of this whole ecosystem. Very tight central control. Under the Genius Act, an issuer cannot share interest payments with the stablecoin buyer. So let's say you buy a dollar stablecoin, I put the dollar in a Treasury bill, I get a very attractive interest rate currently. That goes to the issuer. I cannot pass it through to the buyer. Now, big question. Many people believe that I'll be able to deposit that stable coin back with the depository institution and earn interest that way in a way that would significantly advantage the big banks up against the non-financial issuers. The non-financial firms can issue stable coins, but they need approval from a committee of the top regulators, a special committee set up for that purpose. Now, the hope is who's the buyer? And this is where stablecoins gets very, very interesting. Because what you're hoping is through the mobile payment systems, through Google Pay, through Apple Pay, through the internet, you can market stablecoins to 8 billion people worldwide. And one of the things that to me is the most important thing about the Genius Act is what it has is it has the equivalent of, I would say, plug and play programmability. So with that, I would like to, let's just look at the next slide because I want to show Tobi's article. I asked Tobi, who is an absolutely brilliant attorney and who deals with very complex legislation and financial and constitutional issues, to write an article we just published at the Solari Report called The Genius Act and Its Implications for Financial Transaction Freedom. And what I asked Tobi to do is, I said, Tobi, my read, okay, let's go back to the last slide, the previous slide. I said, my read of this is that you have created a highly centrally controlled vehicle so that all issuers, foreign or domestic, are tightly controlled by the Treasury and the banking regulators, so OCC being a Treasury. And this is set up so that it is so easy to wham, slip in a plug and play social credit or other control system. So with that, Tobi, let me invite you in. Tell us about the Genius Act and what you think it says about programmability.
Well, I guess we already covered practically the vast majority of what I was going to talk about. So it's going to
sorry. Well, but repeat it because we need to hear this again.
I'm having down the most important points, and I would say what you just mentioned is probably the most important takeaway. If someone doesn't remember much else, the most important aspect is probably the aspect of programmability and surveillance. In that regard, stablecoins really are not much different from central bank digital currencies that most people are pretty aware of at this point and righteously pretty concerned about, in which there is reasonable legislation both on the state and on the federal level against in America. Other countries, including the European Union, are still planning to roll those out. But basically, stablecoins are, I don't think it's unfair to say, central bank digital currencies just with a different issuer. So they're not issued by a central bank. They're basically issued by private emitters. Now, that can be private financial institutions. Somebody brought up the question earlier, can big tech be involved in this? So technically, the Genius Act does not allow somebody, an entity that is not primarily engaged in financial services to emit stablecoin. However, there are a number of ways around that. One is it can get approval. Two, a company can form a subsidiary that is not majority owned by the parent company that can then emit stablecoins. And of course, a financial institution can also own a subsidiary. So at this point, let's say, for example, a company like, say, Apple would not be allowed to directly issue stable coins, but Apple could own 49% in a company that does, or a bank could own a majority in both Apple and a stablecoin emitter. So that would be a way.
But couldn't the committee approve them to do it?
And that is absolutely
So
a possibility.
the Stablecoin Certification Review
Correct.
Committee can approve a non-financial public company to issue stablecoins.
Correct. Correct. So that is absolutely a possibility. Now, that company would need to meet certain requirements. But for example, one of the main things that probably people are concerned about is, what about other data they collect? And basically, the simplest way around that is simply for the company to obtain the consumer's consent to the company using that person's data, including non-public data that the company obtains from the user. And if you look at how this usually works in practical reality, is you have a box somewhere that says at the bottom, click I agree, and you have the option to either click I agree or to not use it. And yeah, the aspect of programmability, that term has been thrown around a little bit. Probably some of us or many of us probably have an idea of what that means. But to give you an idea, programmability means that a stablecoin that you have in your digital wallet may not work for you the same way that it works for somebody else. So with $1, you can buy the same thing that anybody else can buy with that $1. But with a stablecoin, you may have different permission to use it than somebody else. And it's actually pretty easy to program it in a way that, for example, let's say you would be able to buy food but not gas. So policies could pretty easily be enforced, such as lockdown policies, or you're restricting certain purchases. Obviously, all kinds of information can be derived from what you purchase. And I would encourage everybody to not make the mistake to anthropomorphize this process too much, but instead think about what an algorithm can already do. An algorithm can evaluate what you're purchasing your money for, or what you're purchasing with your money, and then draw inferences from that. And so restrictions, penalties, sanctions can be rolled out without a human being necessarily being involved in the process. So what do I mean when I'm saying don't anthropomorphize this process? Don't picture necessarily a person sitting somewhere in front of a computer watching every single thing that you're doing. I mean, that is possible, but it's going to be the exception probably. And then making a mouse click to say, okay, you cannot purchase pizza right now. Instead, picture it the way that it works in China. You make a purchase here, you make a purchase there, the algorithm draws inferences from that, and then all of a sudden you try to purchase something somewhere and the transaction is being denied. That is already happening. I had it, for example, that I bought a number of defective items from a national chain that everybody knows, and obviously returned those. And at some point, that credit card didn't work at that chain anymore. Right now, you can still purchase with cash, or you may even be able to purchase something with a different credit card. But if you with a stablecoin, your identity is known, your purchase history is known, even purchases that you purchase somewhere else, and again, you won't necessarily have a human in the loop. Think about if you try to call customer service for one of the major brands, and first you're going to talk to a computer for half an hour, and then you're going to talk to somebody with a heavy accent who doesn't even have access to the controls to basically correct the mistake that just happened, you simply won't be able to make certain purchases anymore. So that's basically what programmability means. We're basically.
And I would say, Toby, reading the legislation, you realize this has been set up so that nobody gets to be an issuer unless they've put together the infrastructure that is necessary for that programmability to come in through the Treasury and I would say the Fed.
Correct. And I mean, this is basically, if you think about it politically, can you really imagine that that a legislator would allow for some electronic means of payment that does not have tools to allow fighting terrorism, allow fighting organized crime, and allow fighting money laundering? Now, I would say all of those are in principle legitimate goals. But of course, the flip side to that is, and I don't want to do anybody injustice with this, I don't necessarily suspect that every person who voted for this necessarily intends to do anything nefarious with this. But we're basically creating a turnkey system where the next administration or somebody who isn't even elected could basically plug in an algorithm, and private companies can do the same thing already. So I don't see the political will to allow for something that has anywhere near basically the freedom that physical cash or technically physical barter has into any sort of electronic system. And I think that's what everybody has to be aware of every single time you use an electronic means of payment. You're basically enabling a system that does not allow for human freedom anymore. Really, you have to see yourself in the tradition of the Revolutionary War of the late 18th century and the Civil War and all the human freedom that we fought for. And Catherine has a really good point that basically slavery was never completely enforceable because there was always a way to escape that. With an all digital global system, you have nowhere to escape because you will not even be able to buy a snack or a train ticket or anything.
Well, you can perfect collateral.
I mean, you could even take it to the step where ultimately, human freedom could be tokenized, and that's not even such a new concept. We already had that in history. But to go back to the stablecoin, the one question that I asked myself is, okay, why would anybody call this Genius Act? Now, the one thing that is, of course, genius about it is, we basically are creating a gigantic purchaser for federal debt. And
right, so now I'm going to, instead of paying with cash, I'm going to pay with federal debt.
Correct. And basically, from the federal government's perspective, this is genius in a couple of regards. So one, you get out of the liability of the FDIC. So if you have banking failures, in principle, the U.S. budget is on the hook for that. Instead, so you don't have that liability anymore under the Genius Act for stablecoins. And in addition, you actually have purchasers of federal debt in the form of every single person who's using stablecoins. Yeah, and at the same time, of course, that for the issuer of a stablecoin is pretty attractive because you do get the yields from the bonds and bills that you have to, basically the U.S. Treasury that you have to hold in order to
right.
to back it with. But it is illegal for the holder of a stablecoin to be paid that interest just for holding it. So basically,
unless they can deposit back in the
right,
holding company of the bank.
Correct, but not for simply holding it. So
right.
If you're depositing it, you're talking about a completely different relationship. Just in the relationship between the issuer and the holder, it is illegal for the issuer to pay the holder out the
right, and that's been tremendously profitable so far for the stablecoins, the arbitrage. So one of the things I want to point out is a programmable digital money issued by the Fed or the New York Fed or any of the sort of central banks has enormous oversight from Congress, the Fed being a creature of Congress, and has public policy obligations to Congress and to the American people. If you look at the banks who are now going to issue the stablecoins, they do not have the same oversight or obligations. So
something with the anti-CBDC Act is basically useless at this point because we do have federal legislation. We have, I would say, in a lot of states, even better state legislation that prohibits the Federal Reserve from issuing a central bank digital currency.
Right. So
But
I
it
would
does
just
not address stablecoins. So the
okay. So we got to jump ahead, Toby. But what I would say is the genius is you get the control of a CBDC without
Correct.
the obligations
Correct.
or the responsibilities.
Correct.
Okay, so let's go to the next slide. Here's a picture of Toby's article, and I strongly recommend it if you want to understand the detail in the Genius Act. But you can always read the act. It's only about 50 pages long, and it's an easy read. And once you get through the definitions of the regulators, okay, next slide. Interestingly enough, not that long after the Genius Act was signed into law, the House issued an executive order on August 7th, so not that long ago, guaranteeing fair banking for all Americans. I'm laughing because Elizabeth and Toby and I have lived through the process of Tennessee issuing laws, stopping debanking for political or religious reasons. But if you read this bill, and it's quite confusing if you read it, you would say, oh, well, it's wonderful. This administration is very much against interference with our financial freedom in the financial transaction system. That's not how I read it. I read they want to make sure the banks can't do any independent system. They want tight control of the control system through the through the Palantir system, operated through the administration. But whether it's window dressing or to make everybody feel good or to make sure the banks don't do their own system, this is an interesting read and very aggressively promotes freedom of the of banks not interfering with our transactions for political or religious or sort of non-reasonable reasons. Okay, next slide. Okay, so this is a bit of a long video that I want to play for you, and it's interesting because I've been part of a debate since 2000, literally 2010, where wonderful crypto people tell me I don't understand technology, and I tell these wonderful crypto people they don't understand control. But I thought this was a very interesting comment after the Genius Act passed by Mike Bentz, who's been one of the people who used to work in the administration who's been very aggressive in stopping censorship. So he was asked about what's happening with crypto and stablecoins. So let's take a listen. Justin, if you could play this. It's about 3.5 minutes.
Crypto's evolved over the years. It's fascinating.
Fascinating story. Yeah. I mean, it's gone from, this libertarian pirate ship for people who want to build an alternative digital money system to a complete tool of the U.S. government to save the U.S. dollar. Rather than fight the dollar, it serves the dollar. All the liquidity comes from the fact that the stablecoin companies are buying U.S. treasuries. So now it's like crypto is what will save us from China divesting of U.S. treasuries and Saudi Arabia potentially moving off the petrodollar. And it's like Paul Ryan pumping it. You have like all these people who, the crypto libertarians hated and railed against. Now they're celebrating, record high Bitcoin prices. And I don't think very many of them appreciate that what's driving it is the opposite of the thing that brought them into it.
Right. I think they're so emotionally invested in the price of it at this point that they're willing to put everything else behind.
Yes, but it's very useful marketing for the government.
Yeah, it's working well.
I mean, I always say this, which is like I'm bullish on bullshit, and I've been saying this for a decade now, which is that I do think that so many of the underlying dynamics, especially around the price of Bitcoin and the liquidity that flows through it, are bullshit. But I believe legitimately that people are going to get very, very rich from it, as they have, because I'm bullish on that bullshit. I believe that there is. I'm bullish on the U.S. government maximizing dollar diplomacy. I believe in the U.S. government being hyper aggressive to prop up the U.S. dollar, and the stablecoins buy the treasuries to do that. And I'm bullish on CIA money laundering. There is an almost infinite need for creative structuring to obscure illicit sources of funds for arms trafficking, for gun. I don't. A lot of people say, oh, you know, they only use crypto or Bitcoin to buy drugs and guns, and they make it sound like the people doing that are, you know, your retail street corner drug dealer. And it's like, no, the large transactions on that are nation states. It's like, look what's happening in Pakistan right now. Pakistan just speed ran the entire regulatory approval for this huge crypto architecture. Pakistan is the global capital of international narcotics trafficking and gun running, and it has been the vassal state of the U.S. government for 50 years, and the UK government, you know, beyond that. This is where we put BCCI, the CIA's proprietary scam bank, to fund the Mujahideen in the 1980s, when we were taking the drugs from the Golden Crescent and laundering it through the CIA's BCCI bank. Now you have crypto BCCI, and it's driving up the stock price or, you know, the price of Bitcoin to huge levels, and I think that's likely to continue. But that's not libertarian, you know, free market, decentralized, plucky underdogs doing that.
Yeah.
It's big tectonic plates.
Yeah, I don't think crypto.
So Mike Pence does understand control. And okay, next slide. It's funny. So I was when BCCI collapsed, Harry Albright was appointed by Morgenthau to run the cleanup team, and he put me on the board, and that was a very, very educational experience if you want to understand global money laundering. Anyway, not surprisingly, the Bank of International Settlements has delivered a stark warning against stablecoins, and the ECB has also been very nervous, and it's extremely important that you understand why. So let's go to the next slide. The Bank of International Settlements for many years has been running a process to institute central bank digital currencies issued by central banks around the world. Next slide. You're going to go to the next slide. Yeah, there we go. So this is a slide from the BIS website that shows their innovation hubs around the world. They've got a partnership with the Fed and innovation hubs, and through this, they've been working and prototyping central bank digital currencies around the world. And you've often, if you are on the Solari Report subscriber, you've often heard me talk about the G20 meeting in Delhi in September 2024, when essentially everyone, including China and Russia, pledged allegiance to the BIS framework of CBDCs globally. And so they have a plan where they're coordinating a global system where everybody is, through their central bank, issuing CBDCs in their national area. Okay, next slide. But in fact, what you are looking at is you're looking at a plan by the New York Fed and the US Treasury together, working in partnership, to issue stablecoins that go out through the mobile payment systems, go out through Google Pay, go out through Apple Pay, and basically try and get 8 billion people, or as many people as they can reach through the mobile payment systems, onto stablecoins that finance US dollars. And so you're basically, I always use the analogy, you see many times you'll see a company tender for the stock of another company to take it over. You basically have the New York Fed and the Treasury working together in partnership to launch currencies that can reach through the payment systems to almost everybody on the planet and get them out of their local currency. So out of the Bolivia currency, out of the euro, out of the whatever your currency is locally, and getting them into dollars. And so potentially, if this succeeds, and that's the question, can it succeed? How many people are there around the world who would prefer to get out of their local currency and get into dollars? If that's a lot of people, then we're going to see money leaving, and this could be in the United States as well as foreign. The local banking system, which is financing farms and is financing local enterprise, and we leave the financing, the blood leaves, financing the fundamental enterprise of that country, and instead starts to finance the US government. And so you run the risk potentially of a giant sucking sound of capital all around the planet, leaving local economies and leaving national economies and moving into the empire. And essentially that could put a lot of countries in a debt trap. You have countries around the world, both their governments and their companies, that they have debt denominated in dollar. And if the capital leaves the local economy and goes to the empire, how are they going to continue to generate what they need to generate the money they need to pay their debt? And so this potentially could dramatically increase the dollar debt trap. Now, right after the wall came down in Germany, after the Soviet Union collapsed, I'll never forget, the discussion was it's going to take decades for East Germany and Western Germany to get together and figure out how to unite the country. And literally the head of Germany, West Germany, Hermann Kohl, offered a premium to bring in the East German currency and collapse into the West German currency. Everybody in East Germany immediately shifted into the West German currency, and the country was unified literally overnight. Ba-boom, ba-bang. That was it. He basically tendered for all the East Germans through the currency. And I'm grossly oversimplifying, but that is essentially what the U.S. government is and the New York Fed is hoping to do. So if you're the BIS, instead of a world where 100 plus central banks issue CBDCs, all coordinating through you, the New York Fed is going to tender for 8 billion people and have everybody basically coordinating through the New York Fed. So you can see why the BIS is a little, what? Okay, next slide. Now, lest you think that I am kidding about all of this, believe it or not, and don't blame me because this is a dreadful movie. There is a new movie out with Viola Davis playing the president of the United States. It's called G20. And the US president heads to the G20 meeting in South Africa. And I would note this year the G20 meeting is in South Africa. And her primary goal at the G20 meeting is to persuade the world to allow the US to issue stablecoins all around the world. And with stablecoins, and we've seen inklings of this, but there's still not a lot of published material on it, is the plan to, through stablecoins, issue credit all around the world. So dramatic amounts of credit to particularly small farmers. So in the G20 movie, she wants to use dollars to loan dollars through stablecoins to all the farmers of the world, which is, if you want to control the food supply centrally, it's a great way to do it. But I said to somebody, this is the crypto digital equivalent of the Iraqi pallets of cash. When the Iraq war started, we used to ship over pallets of cash to get everybody off the dinar and move them onto the dollar. And you are potentially going to use stablecoin related credit to flood the world with credit. One way to get people on your frequent flyer miles is to give them 100,000 frequent flyer miles for free. That's the equivalent of credit. So, if the G20 movie is any inkling of what the marketing plan is, what I would suspect is we are facing the possibility of extraordinary amounts of what some people call helicopter money, which is potentially very inflating. Anyway, so this is our review of the G20 movie up on the Solari report. And again, not good entertainment, but a very interesting comment on the potential stablecoin marketing. Okay, next slide. Okay, so as you know, at Solari, we are very concerned about the end of financial freedom. And so more than anything, we track what is happening to build the control grid. I said in the summer last year, I thought that the establishment was going to put in Trump because he could get the control grid quickly. And the Trump administration has been moving very quick. One thing you don't see when you read the Genius Act is the explosion of building of consolidating all the federal controlled data into a few corporations in the cloud and one data analytic firm, and that firm is very much involved in military applications and security surveillance and control applications. So while the Genius Act is promoting essentially a crypto framework, we see an extraordinary effort at the federal government to consolidate and privatize government data using AI, and a small handful of contractors who are very involved in surveillance and military applications. Anyway, we update this checklist every week, and if you want to understand what we call the fast approaching digital control grid, you will find updates. You will find an up, and it's remarkable how many things are happening and coming together. One of the things that most concerns me is many people don't see this because they see different things happening in different areas, and they don't realize that this is like a corral where the different pieces are sort of aggregating and can be snapped together. I just watched a great presentation on geofencing and what can be done with biometrics to basically, between people's programmable money and programmable electric cars, lock them into control in certain areas. Okay, next slide. Okay, so as you know, at Solari, we love cartoons, and this cartoon says it all. No, we don't accept CBDC payment here. We don't want to legitimize the digital control grid. And the fellow says, agree, that's why I pay with stablecoins. And she says, you're not listening. Back to meet the new boss, same as the old boss. So stablecoins leave the door open for significant central programming. Okay, next slide. Okay, so before I go on to what's the action, what can we do? Any questions about the Genius Act and where we are with the passage of the Genius Act?
So, Catherine, after hearing all of these reasons that the stablecoin could have a very nefarious impact on all of us, how do you think they're going to market this on a global scale? And how do you think, we got a couple questions, I'm trying to wrap several questions together. So one is the marketing issue, and two is, how is the interplay between maintaining that dominant position worldwide as a global reserve currency vis-a-vis the BRICS countries and their increasingly important role in the global financial markets? How does that interplay work with stablecoins?
Right. And oddly enough, it's one of the reasons this coming meeting in Alaska is going to be so interesting. Because to a certain extent, you have Trump meeting with a very important representative of the BRIC nations, so to speak. Okay. So here's the beauty of this. And we just did a great interview with Mark Goodwin and then one with Darren Moore on stablecoins. You have countries all around the world and central banks all around the world looking at the stablecoin plan, with horror. Everyone thought they were in a scenario where every country did their own thing. And if I'm the central bank in my country, then I have control in my country. Yes, it's a control grid, but I'm the middle management in my country. And now we're talking about a plan where the administration of the United States is essentially tendering for all your tendering. Think of this as a hostile takeover, to basically switch all your citizens off your sovereign currency and onto their sovereign currency. So if you look at the discussions that countries around the world are having about what they do about this, one, as a legal and hardware management issue, can they keep you out or keep your stablecoins out? Number one. And number two, can they issue stablecoins to compete with you? And I suspect, and this was what Darren said on our interview, I suspect you are now going to see a blossoming of competition, both private and public, for people to outcompete the US and get you into a better stablecoin. So let's say the Koreans issue a stablecoin and they can offer interest directly without you having to deposit back in that depository institution. And everybody says, well, I get 2% on the Korean or the Australian stablecoin, so I'll go to them. So I think what you're going to have is you're going to have extraordinary competition. And that competition is not only going to be between financial products, it's going to be between propaganda, mind control. I mean, you know, we're talking about something that surveillance that could get very, very wild here. So, you know, I think the U.S. has put out a plan which is very bold and has put a lot of fear into a lot of people globally, and they're going to push back with their own CBDCs, their own stablecoins, their own laws, and other things. And so we could be in a period here that could be pretty wild. I don't think anybody knows what happens. Now, one of the reasons you're seeing such a rush to do data centers and AI is not because they expect AI to make companies more productive. No, this is about who controls the currency and the money. And you know what they're hoping is the guy with the best AI and the guy with the most chips and the guy with the most data centers who can crunch the most data with the most satellites can basically win this market. But you're talking about an enormous competition globally for the financial system. Now, one of my concerns is you've got, in many respects, a very productive and healthy financial system, you know, away from stablecoins. We haven't talked about tokens and digital assets. That is going to get even worse because they're planning on making digital assets that tokenize every asset on the planet. So stablecoins is just step one, and I look forward to doing a briefing on digital assets. But you know, the extraordinary potential sucking sound out of the existing financial system into basically a distributed ledger system, which allows far more programmable control, could really be devastating to small businesses and small farms. And I think one of the great opportunities here is how we make sure we are financing liquidity to the kind of small farms and small businesses that we want to see thrive in this environment. So I think you're talking about real competition and fracturing in all aspects of the financial system. I don't think anybody knows where this is going to go.
Catherine, we had a question from Ted Williams. Can community banks offer stable coins without connecting to the Fed system that could monitor transactions?
So you can create stable coins. So a local bank or credit union can create a subsidiary, and up to 10 billion, you can be state regulated. Whether or not you can avoid the Fed systems is a good question, and I think there may be a possibility, but I'm not sure. And if I was a community bank, that is exactly what I would be looking to do, to find a way to do this and keep the systems, particularly within the state jurisdiction, off of the main systems.
Great. We had another question. Why doesn't the BIS just control through the Fed stablecoin instead of their own CBDC? I thought the BIS is pro-centralization, and stablecoin, if successful, should be great at centralizing banking control. Wouldn't it be easy for the BIS to control the Fed?
No. So the Fed, the New York Fed and the Fed are shareholders in the BIS, but they are not under the BIS control. And not to say that the BIS doesn't have extraordinary powers. What this comes down to ultimately is who controls what military capacity and who can essentially force, you know, what systems can do what. But no, the BIS is a coordinator. One of my questions, and I don't know the answer, if the BIS was intimately involved in laundering the 21 trillion or whatever money is missing from the federal government or whatever illegal transactions were going on, you know, that could give them extraordinary powers. And but we don't know.
Ted says, I thought that you might want to hear this. I had a US senator tell me that stablecoins are just a transaction platform where cross-border and wire payments could be made easier, quicker, and cheaper. I really expect this technology to replace about 50% or more of the Fed wires that are happening today in the next 5 to 10 years.
So that could happen. I mean, that's one of the functions. And if you look at the cost of transacting internationally, it's very expensive. And of course, the hope is that crypto platforms will make that much faster, cheaper, easier, much more instantaneous. So could it pull a lot of money from the existing systems just for transaction purposes? Yes. But I don't think the main goal here is to improve international transactions. If you look at why international transactions are the way they are, it's because they were that way for control. They were that way so that you could have very tight central control of what money could move where and who knew, who knew. So I always tell one of my favorite stories is a wonderful reporter I was working with in Washington who was covering the narcotics trafficking when I was trying to understand the use of mortgage fraud to launder narcotics trafficking. And anyway, I was helping her with research, and she went to have lunch with a top DEA agent as he was just retiring. So he was just been retired for, very briefly, but he was finally out. And he said to her over lunch, she came home and told me, she said, let's face it, honey, all the wires batch to the New York Fed and go through the New York Fed every night. They know where every penny is. so, so, as Mike Benz said, we know who controls all of this. So I think with this technology, you can have as much central control as you need or want, but now you can go much faster with lower transaction costs. But if you think that's the purpose of the system, I doubt it, because they could have made things go better, faster, a long time ago.
This is from Scott. Since Treasury notes, bills, and bonds are collateral for the stablecoins, does this mean that the national debt will be privatized to the holders of the stablecoins, or will the national debt still be based on the full faith and credit of the United States, which means the economic value of U.S. citizens?
Right. So the Treasury bills and bonds that get sold to stablecoins are still going to be full faith and credit. So this is simply another buyer. So as the deficit continues to grow, you sell more Treasury bills and bonds, and stablecoins pick up what to me is a relatively small part of the market, unless this really explodes and succeeds. I mean, here's the reality. If you look at the technology that's being used to do surveillance and influence or control foreign leaders around the world, if you look at the systems that are being used to basically track and influence and control, consumers and citizens, if you look at what can be done with programmable money, if you look at all these different systems as they come together, you're not talking about just building a market for treasuries. You're talking about basically tendering for citizens who now are going to be part of your economy, not their local economy. So you're basically trying to build a market share for the dollar that is going to move a tremendous number of global citizens into the dollar economy where you're going to control. You're going to control their money. You're going to be able to do surveillance on them. You're going to be able to program their money. You're going to assert much more control of those individuals. They may not be in your legal jurisdiction, but they're in your financial jurisdiction. And to a certain extent, it's that way now. If I have a bank account in Zurich and I hold dollars, those dollars are deemed to be in the United States, and I'm under U.S. jurisdiction with respect to those dollars. Any more questions?
Toby had messaged.
I have an answer regarding a constitutionality question that somebody brought up. Somebody threw into the chat that this would be unconstitutional, and I wish that was the case, but it is not. Article 1, Section 8 of the Constitution for the United States says that the Congress shall have the power to coin money, regulate the value thereof, and a foreign coin, and fix the standards of weights and measures. And then regarding states' abilities, Article 1, Section 10 says that no state shall make anything other than gold and silver coin tender for the payment of debts. And that is basically as much as the Constitution says about this. So unfortunately, Congress can absolutely declare, okay, we're making silver, or we're making rice bushels or whatever legal tender, or create some new form of legal tender. One could argue that it doesn't say that only Congress has the ability to coin money. But anyway, the Constitution definitely gives Congress the authority to do that, and gives states the authority to create or to declare gold and silver legal tender, but it does not say that only gold and silver are legal tender.
Right. Okay, so let's go on to the next section. So the Solari team, working with Elizabeth and Tobi, spent really 2 years working on what could state officials and legislators do to protect financial freedom. And what, of course, we discovered is that those issues are very integrated with food and health freedom. You know, it's freedom is sort of one issue. If you go to the next slide, and we have prepared a website and lots of written material. We wrote a wrap up that accumulated all of the different actions that state legislator and officials could take. And it's exhaustive, and there are many different ideas. It's like a buffet. And I would really encourage anybody interested to read it and say, okay, you know, what's one or two ideas here that I could pick up? We also put up a website called Financial Transaction Freedom. We have a mailing list. Elizabeth sends out a report every week. There's a wonderful section, thanks to Susan Luchas, called Team Cash. And our priority right now as a team, what we've found, there are many different things that state can do, but the one thing that they can do that we think is essential is to protect the analog transaction systems and to protect cash. And what's interesting is because of disasters, we've seen a remarkable turn in citizens around the world and central banks, you know, starting to realize cash not only protects financial freedom, but in a disaster, it protects your ability to function. And so we're starting to see cash, which was becoming very unfashionable. And during the pandemic, there was an effort to move us away from cash. We're starting to see much more support on cash. And so we, right now, Elizabeth and Susan and the Solari team are focused on what we can do for cash. Susan is focused in her state of South Dakota, but she's made remarkable progress there and lots of information at Team Cash. I want to turn it over to her to talk a little bit about what she's doing and what you can, the resources you can find at Team Cash at our Financial Transaction Freedom website. So, Susan, I'm turning it over to you.
Thanks, Catherine. So the very good news, as Catherine said, is there's something very relatively simple that we can all do, and that's pay with cash every day. And that means, if you could go to the next slide, Ricardo, please. That means, you know, your credit card becomes your backup plan instead of cash becoming your backup plan. And that's something that we can all do to protect our freedom. And what I found in our research for our cash legislation and for pushing cash in our state is that about 18% of payments made in the United States are cash, and about 18% of people don't have a credit card. So those statistics are from 2022 and 2024. So what that's telling me is a lot of people paying with cash are the people without credit cards. So now what we need is everyone with credit cards to put them away as a backup payment and start using cash. And you can say, oh, well, I missed my 5% cash back. Well, that's the cost of freedom. And I think that's a relatively small cost to pay right now versus what the cost could be in the future when this digital control grid is to snap into place. So on the Financial Transaction Freedoms website, Solari's done an amazing job putting up all of our documentations, all of our statistics, some fun pictures, all the things we've done on cash, including the document for stickers that you can put up on the back of dollar bills and give them out. I also want to point out this is a fantastic time to talk to your representatives in your state and start talking about a cash bill. And it might just be like ours that we got passed that just requires acceptance of cash at school events. It could be requiring businesses to take cash. It could be just a joint resolution to promote the use of cash in your state and promote cash businesses and support cash businesses. So anything you can do to approach a legislator at this point in time before the session really kicks in it's a great time. And even if they just look at you funny, hey, you planted a seed and you used the word cash and you spent a few minutes of their time talking about cash, whether they wanted to talk about it or not. So good for you for doing that. And that's what I'm going to be doing here in the next few months is working on another pushing cash again in South Dakota. And I'm just going to keep pushing it. I will keep pushing it in South Dakota until I have 99% of people in South Dakota paying with cash all the time. That's my goal. And I won't stop until I get there. So y'all join me and push cash in your state.
So, Susan, one of the things that really stunned me was when I learned, because you did wonderful testimony for the school bill, and it's up at the Team Cash and Turtling for Cash on the website. I was amazed at how much the credit card companies take out of South Dakota every year. And the number is amazing, particularly because families are really being hit by inflation. And that is an enormous amount of money that could, one, they can use that money to buy goods and services, but the local businesses can use, will make profit with that. And that's an enormous amount of money that's just being exported out of the economy unnecessarily because everybody's using their credit cards.
Right. So in South Dakota, we have about 1 million residents. We're a relatively small, sparsely populated state. And we give about $700 million a year to credit card companies that are not based in South Dakota. So that's about $700 per person in South Dakota in just credit card fees that go out of state. And a lot of people don't realize that. So, and we can all be controlled by this digital control grid. So not only are we giving a lot of money away outside of the state, but we're also subject then to losing our freedoms, even though South Dakotans think they're freedom-loving people and they think they're prairie Republicans that really believe in freedom. We could easily be controlled by people outside of the state in these digital currency sort of situations.
So the picture up on the right, I have to brag on Susan, is her Cash is King Halloween costume, where instead of giving out sugar, because we do want to make America healthy again, she gave out dollar bills with little messages on why you should use cash. And so all the kids went home. They like the dollar bills. They don't mind not getting M&Ms. They like the dollar bills, and they went home and told their parents why they should use cash, right?
Yep. It was amazingly successful. And even if you don't want to give out dollar bills, because I learned if you give out dollar bills, you quickly become the most popular house in the neighborhood on Halloween. But you can also give out quarters, you can give out dimes, pennies, anything. And on this website, Turtling for Cash, you can download the file that you can print on your computer. You can just print it on normal paper. And you can just scotch tape the penny to the back of the message or the nickel to the back of the message. That's what I did the first year.
Yeah, that's great. Thank you, Susan. Okay, Elizabeth, I think I'm turning it over to you.
Sure. So just to piggyback on some of the things Susan said, so we at Solari have been really focused on promoting financial transaction freedom for years, as Kathleen mentioned. And in the last legislative session in Tennessee, we had 2 bills related to that. One was no sales tax on cash transactions under a certain amount of money. We had hoped to have $100. We took it down to 20. That still had some issues within the state, but it really started the conversation. We also have a bill that's still active. We'll be running it again in January that will require brick and mortar businesses in Tennessee to accept cash period. I know that there's going to be similar bills in Tennessee, Alabama, North Carolina. I know Susan's working on more stuff. And so I just wanted to say, if anyone's interested in working on this in your state and you just want to maybe talk the process through, how to meet with your senator, your House rep, how do you get them to sponsor such a bill? How do we provide them with the language? I'm happy to help you with that. My email is elizabeth@solari.com. So feel free to email me and we can set up a time to chat if that's something you want to pursue.
Okay, so on the state legislators and officials, let's turn to question and answer. Oh, I should mention, so Elizabeth, we've got incredible interviews. So we did, Toby just published the article. We did an interview with Darren Moore. Mark Goodwin wrote a fabulous piece on stablecoins and then did an interview with me. He's coming back. He's doing a series called Digital Money, Digital Control. And episode 1 was on the new financial system, and then on our stablecoins, the retail CBDC, and remarkable amount of information from some really brilliant people looking into this. So,
and I just encourage anyone who's listening who's not a Solari subscriber, as Catherine just pointed out, we have some amazing resources on Solari for our subscribers. So if you're interested in becoming a member, we'd love to have you.
Absolutely. Okay, questions and answers.
So Ted asked, is using cash better than pursuing a state gold silver coin?
So I don't think it's either or. I mean, I think it's unbelievably important to preserve cash and the analog system, but I think coins at the state level is another form of analog system that is terrific. So, I think the more analog options we have, the better. Cash to me is great for transactions, but as a store of value in this environment, particularly if stablecoins are as inflationary as I think they might be, there's tremendous argument to stay in real assets, which of course gold and silver is. So I'm a great proponent of gold and silver. So I think you want to do both.
So this might be something that Toby can speak to. Scott says the Gold Act of 1934 states that no obligor nor obligee can require the payment of any particular type of coin or currency, which means no public business or government agency can refuse cash or any other legal tender. Yet we're seeing businesses refusing cash across the country. Toby, would you like to comment on that? I know you're our legal scholar. You're muted if you did want to comment. Okay, well, let's see what else people are saying.
So I would just say, our research has, again and again, we see attorneys coming back and saying, there is no obligation to take cash. There is an obligation to take the legal tender, but it doesn't have to be in cash form. So, there is definitely debate over this point. And I think I will say this, the Tennessee legislature has always been reluctant to mandate cash because they hate to tell private businesses what they should and should not do. So there's a desire not to interfere with private businesses. At the same time, if you look at the strategic importance of maintaining the analog system, it's one that I think conservatives can get over.
Okay, I'm just scrolling the questions right now.
So maybe to round off a couple questions into one, there have been a ton of questions around gold-backed currencies or initiatives that weave that in. Worthy of mention is that last month we did a state briefing on digital gold initiatives, and the recording will be published shortly. It's not up yet, but it will be published shortly, and that will go into some of the specifics of these quote solutions.
Right, and here's the thing to remember. With any digital system, whether it's gold, whether it's dollars, whether it's wampum beads, can it be centrally controlled? Will it put you under surveillance, and can it be centrally controlled? And if you don't keep your analog systems going, can that put you in the corner and squeeze you? So, this is not about gold and silver versus the dollar. This is about how we make sure, whether it's surveillance or programmability, that we can't be centrally controlled. And the danger is an all digital system. And I don't care even if you call it wampum beads. An all digital wampum bead system is not safe. What I don't want to see is you have many wonderful people who believe that gold and silver offers sound money. The problem is if you put it in the wrong kind of digital system, it has the potential to be the most unsound money we've ever dealt with. So especially because the collateral may not be there. So anyway, it's a complex topic, which is why, of course, it's best to listen to the briefing we did last month.
Here's an interesting question, Catherine. So the question is, how are stablecoins going to affect 401ks?
That's an excellent question because we just saw the administration loosen the 401k requirements to essentially allow crypto and unfortunately private equity into 401ks. Now, if stablecoins are marketed to 401ks from a financial matter, it's no different than, essentially putting a short-term treasury bill in, although you don't necessarily have the same protections as direct ownership and their risks according to the intermediary. But I'm assuming because of opening up the 401ks to crypto, that you could easily see stablecoins, end up in 401ks. Now, if they can't offer interest in the first blush, you can't imagine why 401ks would want to buy them. I will say this, given the changes that just got made to 401ks, there is a reason why everyone listening to this should pay attention and make sure they know what the 401k administrator, what options they're allowing, and to make sure they know what their 401k is going into and to make sure it's acceptable, because I'm concerned that what they just opened up could, you could drive, you could drive some okay stuff through that, but you could drive a whole lot of very unreasonable stuff. So the time has come for serious due diligence on what's in your 401k.
Matt said, or I'm sorry, Minda says, please repeat. Oh, shoot, I just lost it in the chat. I think she wanted you to repeat something you just said. Let me scroll back up. Please repeat what you said about the danger of, about the danger of gold and silver. What about a depository like UPMA Alpine Gold?
So what you want to make sure with a digital gold and silver system is that the depository is trustworthy and the expenses are reasonable. And it's really a matter of due diligence. If you look at the gold and silver systems being proposed for states, the issue gets more complicated, because if a state is going to allow gold and silver to be legal tender, but it doesn't have the authority to audit and make sure the gold and silver is really there, then you get into all sorts of very messy questions. You remember, our goal with all of these different systems is to preserve our financial freedom, and that means preserving the sovereignty of the state and the individuals. And you can implement digital systems that are just going to make it worse. And any digital system can be programmed and can institute the kind of controls that central bank digital currency has, which is why, again, it's very, very important to focus on what can be done analog. And to keep the analog systems healthy, because if we go to all digital, and again, I don't care what the whether it's fiat currency or gold or wampum beads, we're in trouble.
And if I can try to keep it quick and piggyback on that, what I see here is they're pushing gold-backed currency or silver-backed currency. The problem is it has to be digital. So meaning it has to be controlled. It can be controlled. Now,
Right.
Why is that? That's because you can't buy a carton of eggs with gold or silver. The denomination is just too low. I mean, at that point, it has to become digital so you can make change and, and purchase in small amounts. So they're pushing gold and silver as sort of this freedom currency, but actually it's basically a digital currency in sort of disguised as freedom. I talk about cash one more time. I saw a comment.
Yeah, please.
I saw a comment about cash and concessions at stadiums and things like that. I can tell you here in South Dakota, I think we mostly do take cash still in South Dakota, more so than other states. So I think we have a better situation than a lot of y'all do. But my family still refuses to support any business that does not take cash. And we have got to do that. We've got to pay with cash every day. And if that business or that event doesn't take cash, we just have to stop supporting it. We have to vote with our money and vote with our wallet and basically defund it. I mean, that's the way I see it. And my family sat outside my kids' events all season last year with all the other people. We sat outside and we couldn't get in because we had cash and they wouldn't take it, and we just sat outside. And you know, you got to do that, because soon, instead of just sitting outside your kids' events, you know, they're going to want to take your kid and transgender them and you know, give them to the pedophiles. And you know, that's way more serious than missing a football game, or you know, at that point. So let's not get to that point. So let's pay with cash every day, and let's not support businesses that don't take cash.
So one of the things I love about you, Susan, is you understand this is what this is about. In other words, if you look at what they can and will do if they get complete control, it's quite frightening. So yeah, so
human freedom will no longer be a viable concept if we lose the ability to transact offline.
right. Right. I keep saying this is for all the marbles. Okay, any more questions? We haven't heard from Carolyn Betts. Is Carolyn still here?
Yeah, I'm here.
Any thoughts before we wrap it up, Carolyn?
Well, I'm still trying to figure out how MasterCard and Visa, for example, would use stablecoin, whether using an existing thing to pay for something could end up being a stablecoin transaction. And I don't know if anybody has any thoughts about that.
So I think that's a very important question, because clearly Visa and MasterCard are very much in the thick of things here on crypto, but I don't think we know that yet. But I think they're certainly planning to. We've got a question.
Might have a thought on this one.
Go ahead, Toby.
I mean, we can all really just speculate right now, but based on the Genius Act, a business that is primarily engaged in financial services could emit a stablecoin. So Visa, MasterCard, American Express, Discover could issue their own stablecoins, and that way they'd remain business.
Yeah, absolutely. Okay, could you take Werther has a question. He's got his hand up.
Thank you, Catherine. My question is, how is this going to affect the business model of community banks and credit unions? Is it going to put their solvency at risk if they're competing against much larger banks? Will this lead to further centralization?
So I think this is an excellent question. And it's an excellent question for two reasons. One, this could really threaten local community banks and credit unions. But when it does, it can threaten small business and small farms by basically sucking the capital out of Main Street into the Treasury market. So one of the things I've said to my bankers is you need to take a hard look at this and understand what you need to do to succeed in this environment. And I think there's nothing more important than to figure out how we protect local economies from that giant sucking sound into the Treasury market and into central control. I think this has the potential to put a lot of to further consolidate the small community banks and credit unions and devastate the capital circulating on Main Street.
I'd like to point out one thing regarding I think Elizabeth asked me that question earlier. Correct me if I'm wrong, though, if I missed it, but comparing gold and silver and cash. Susan is absolutely 100% right. Protecting cash is the most important thing we can do to protect our basic freedom. I view gold and silver as a backup. Now, I would argue that you can, especially if you use silver, use those for everyday transactions in theory, assuming you find somebody who's willing to accept it. A silver ounce is worth about $20, $30. You can buy a meal with that. If you buy so-called junk silver, so pre-1964 quarters and dimes, they are the equivalent of like what's $1 or $3 today. So you could use those, but they're a crutch. It's kind of having a generator in case the power goes up. It's a good idea, but you don't cut your power supply.
Well, but there are ways communities could keep the gold and silver stable and pass certificates around. So there are many ways to make gold and silver really work, but you need a tight-knit community. So the wonderful Frank Gaffney is here, I see. So if we could unmute him and he could ask his question.
Thank you, Catherine. This was a spectacular presentation and enormously troubling in just about every respect.
I'm sorry about that. So
no. Well, this is
I
the
used
world
to have
we're
a
in, isn't it?
pastor who would say, "If we can face it, God can fix it." So
Yeah.
I
Well,
like to turn before. I like to see the iceberg early and turn quickly.
amen. Amen. And I thank you for being at the bow of the ship, warning of it. I did want to just come back. Friends of mine have been instrumental in bringing about this transactional gold and silver legislation in 5 states. I've been supporting them in doing it, and am concerned about some of the things that you're saying here that could afflict it as the digital back end, at least, that makes it work as a transactional system. I don't know whether the statutes that have been adopted in, I think, all 5 states that are designed to, ensure privacy and protect against the sorts of abuses that are obvious in the stablecoin case are all that they need to be. Point one, obviously, anything that's put into statute can be amended and changed down the road. But have you looked at both what has been done by the sponsors in Florida and Texas and Missouri and Louisiana and Arkansas? And if not, are there other things that might be put into the legislation to address some of the concerns you have?
So I've looked at some, but not all. And I know that my understanding is that the one in Arkansas was just turned into model legislation at ALEC. And I'm happy to look at that model legislation if somebody wants to send it to me.
Good.
But I have to tell you, I've never seen anything yet that I think begins to protect against what is intended with the digital controls. So if you look instead at who's building the digital systems and how they intend to interact, there's no digital system that I've seen that is prepared to try and stop that.
Because it's technically not possible, or because it's just not been
Because they don't
the intent.
They don't have an understanding of how control works, and they don't have a local or state infrastructure that's prepared to take governmental action to protect them. So I don't want to get into gold. As Susan said, we did something on gold digital systems last time, and as soon as we get it up, I would suggest you listen to that.
Will do.
But if you want to send me model legislation or send it to Elizabeth, we're happy to look at it.
Sure. Could I just ask one final question?
Sure.
Catherine, given what you just said, would you be able and willing to consult on informing people who may not have your appreciation of the control piece as to how it might be worked or addressed, at least?
So I don't know if you're talking about, so I did meet with the head of Glint and gave him a list of what would be needed to protect sovereignty in a state level.
Good.
So he should already have that.
Okay.
But the best thing is for me to look at the model legislation, and I'm happy to respond. But I'll be blunt. I've never, and I've said this from 1999 on, I've never met a digital system that couldn't be centrally controlled. That is the nature of the technology, is the nature of how and why it was launched. And unless we have analog systems and healthy analog systems and are prepared to have a balance of analog and digital, we are going into a slavery system.
No
And
government in the world is going to give you a system that does not allow for protections against money laundering, terrorism,
Right,
organized
right.
crime, and those can all be abused for total control.
Right, but it's, for me, it's very, it's a matter of enormous grief that I see so much talent and time going in to building a variety of different alternative digital systems when in fact there is no solution here that's digital. You have to have a balance of analog and digital, which is why we've decided we are just focusing 100% on analog. And I'm not particularly interested in helping digital systems work. I'm interested in helping analog systems work and helping state and local officials understand why they have a vested interest if they want to be a sovereign government. Because remember, the control system that's being built, not with stablecoins, but with Palantir and the Amazon cloud. If you look at the control system that's being built, that system is going to replace the legislators. The executive branch and the legislators are going away because you can have taxation without representation and do all the regulation through the AI and social credit systems. You don't need legislators and you don't need executive branches. The bankers can control and implement all fiscal policy ultimately. That's what the data centers and the AI are for.
Yeah, I wanted to follow up. If this is a threat to the smaller community banks because of the capital outflow and just because the larger banks will be better prepared, what could a sovereign state bank potentially do to help support the community banks and the businesses that they lend to? Because I know that's a project that you're focused on, and that I really want to come to Florida. And, one big selling point that we could give to the credit unions and the smaller banks in particular is to say, look, if you guys don't have this institution, which can support you and provide the infrastructure necessary to make sure that these federal controls or these other controls don't impact your business and cause you to go out of business, then it's over for you, basically, right?
So one question, and this is a question, is could a state bank, whether it's owned by the state or owned by the state banks and credit unions, because you can use the New York Fed private model too, but whether or not under the Genius Act, it could be the stablecoin regulator for the state, and by the local banks and credit unions setting up, 10 billion or less stablecoin operations that they use to, sort of compete in the state, within the state jurisdiction, including setting up systems that will allow them independence from the federal systems, what the opportunity is there. Did you want to say something on that, Susan?
Understood. So basically give them a governing seat on the board as well as the state government.
So they're different models, and it depends on what the laws are in the state. A state bank could be owned by the state. That's the North Dakota model. But you can also have a model where a group of community banks get together and create a bank which is dedicated to doing the state's business, but also in doing some of the functions that the Bank of North Dakota does locally. But if a state needs a stablecoin regulator, the question is, could a state bank, in whichever ownership model you use, you only want a state bank if it's a successful partnership between the local banks and the state. If there's no reason to do and have that kind of successful partnership, there's no reason to do a state bank. You want a bank that protects, as you want healthy community banks that are growing and thriving, and the state bank is there to protect that infrastructure.
Correct. And that's the model that we would want to set up in Florida.
Right. Right. And, I don't think there's any one of us who really understand what stablecoins could do to shift capital out of local banks and into the crypto market, I don't think we know, but I am quite concerned that you could hear a giant sucking sound out of Main Street and into the Treasury market in a way that would be very bad, not just for circulating, loans on Main Street, but circulating equity.
Understood. Thank you.
I should point out that our original fight, Carolyn can tell you, our original fight with the Department of Justice is we were setting up local stock markets. I always say I can go down to the Hickory Valley grocery store and buy $1 million of lottery tickets, but if I try and buy stock in the Hickory Valley grocery store, I'll go to jail. Okay, Frank, you want to unmute Frank, Elizabeth?
Sorry, Catherine, just one last question. Thank you for giving me another shot. The thing that I'm a little bit unclear about in terms of your focus on analog is, if I heard you correctly in the beginning of the presentation, one of the features of the stablecoin is almost certainly going to be an inflationary impact on the dollar, would it not? And does that
it
undermine
doesn't,
your efforts on the analog currency?
it depends. There are many other things going on at the same time. So if you look at many things happening at the same time that could be deflationary, it doesn't have to be inflationary. If they flood, there have been several articles, and then of course the G20 movie, Frank, that made us. It gave us the sense that they're planning on combining it with aggressive credit lending, but I don't know that for a fact. What I do know is when they do something like this, it is the Iraqi pallets of cash, and they are aggressive in, sort of giving away frequent flyer miles. If they do that, yes, it can be exceptionally inflationary. But I think if you look at what's happening with AI and automation, you have other things going on which are highly deflationary. If they roll out new energy technology, that can be highly deflationary. So it's very hard to predict what the net effect is. If you look at what I'm seeing in the economy right now, I'm seeing inflation. And if you look at what Powell is doing with interest rates, he's very concerned about inflation. The new wholesale prices just came up today, according to the Financial Times, up 3.3%. If you look at the polls, everybody's worried about inflation. And so I think, certainly in the short and intermediate term, we're looking at potentially serious inflation.
So
that's what I fear too. Thank you.
OC has a question. How do we empower local banks that can lend to SMEs and keep money local? Is the train too far gone?
No, I don't think the train is too far gone, and I'll tell you why. If you look at new technology and automation, in theory, it ought to help the little guy up against the big guy, but it takes lots of organization. So if you go back and look at what Carolyn and I were working on in the 90s, what we were working on is local small businesses, local farms organizing to basically do pools of venture and other things locally where they could really jump the curve on the whole shift into new technology. And if you look at what energy technology can do to bring down the cost of energy, that should be very helpful to, real estate and all sorts of businesses and assets. So I think there's an incredible opportunity here. And if you look at what can be done with new technology and young people to help us really get back in the game, there's tremendous opportunity, but it requires organization, it requires leadership. And I'll be perfectly blunt, with rare exception, and Ted Williams is here, so he's a big one. Big kudos to him. A lot of people are feeling, business is fine, we're making money, we don't need to hear about all of this. And so there's a complacency that we're running into at the state and local level, which I think one of the reasons I try and communicate how disturbing the vision of stablecoins is because it's that disturbance that will get you out of your chair and say, we have to figure out how we're going to be successful in this environment. And not only do we, the community bank or the community credit union, have to figure it out, we have to get together and organize locally to do this. So I'm hoping to see a lot less complacency and a lot more interest in jumping the curve on the situation. I think there's tremendous potential here. I just saw, Susan's going to laugh because she's also, of her many hats, she's a farmer. I just saw a graph that we had in Money and Markets where it showed what percentage of a country bought their food locally. And Switzerland, which is one of the healthiest countries in the world, 45% of the local food is the household budget food is purchased locally. And I know because whenever I go to Switzerland, we go to the farmer's market and we buy this beautiful food, and we go to the local butcher and we buy local food. America was at the bottom at 10%. Imagine how healthier we could be if we could take that back up from 10 to 45%. And part of the opportunity locally is if we can combine food and health and money together. And that's where you really start to have integrated solutions on many of these things, because the existing system, the existing health system isn't trustworthy, the existing food system isn't trustworthy, and the existing money system isn't trustworthy. And the breakout solution for all of us is to organize integrated solutions that combine those things together. And the economics are there if we are willing to look at it. And many of us have the capital. If you look at where all of our capital is, it's sitting at the 401k financing all these guys building data centers, which are going to take all of our water. So we're financing this. Okay, any more questions?
I think that final comment addresses one question in there, Catherine, which is what we can do at the individual level. And I think you just said it so brilliantly. We're all complicit in this. We're financing it. So we vote with our money.
Right. And but here's the thing. If you go to Financial Transaction Freedom, we have tons of resources. Go check out the Team Cash. There's tons of resources. And what you want to do is you want to take a look at your time and your budget and say, okay, what can I start to do? And we have a memo on financial transaction freedom, and it lists tons of things you as an individual can do, or you as an investor can do, or you as a small business owner can do. But just start engaging with everybody. And when we are hoping to get this briefing up next week, please take this briefing down and get your local credit union and your local community bank and your bankers to watch it and start, get the local Rotary, get the chamber. Let's start talking about, okay, what's coming and what's this going to mean to us, and how do we take advantage? How do we be the smart guys here? Okay. Okay, well, Elizabeth and Justin and Ricardo and Susan and Toby and Carolyn, thank you so much. This team of people has been, it's just amazing what they've done over the last two years. I can't recommend each one of them to you highly enough. And, they're all in on freedom, whether it's food freedom or health freedom or financial freedom, it's all one freedom. And so we're very grateful that you turned out. We're very grateful to have your interest, and we will try and get this up as soon as possible next week, along with the one on digital gold. And just remember, it's amazing what happens when people start to act. And the history of freedom is it always looks hopeless, and then one person does something and the next person does another thing, and it moves virally. Cash is something that could move virally. So, I would say this fight is for all the marbles, but the battle is still young. So there's tremendous opportunity for you to make a difference. Elizabeth, anything you want to add before we close?
No, I think this was great. I've already gotten a couple emails from folks who are interested in working on cash legislation in their states. So if anybody else wants to work on stuff, please email me, elizabeth@solari.com. So We'll keep-
Okay, ladies and gentlemen, you have a wonderful evening and enjoy the rest of the summer.